All right, Veronica, we have to start with this jobs report.
Yes.
We knew it was going to be messy
Yeah.
because of the hurricanes, because of the strikes. I think this was a lot messier than what some people thought.
Yeah, I think it was. And trying to disaggregate those strike and hurricane effects, I think this was a weaker reading. Most importantly, I think I'm looking at that increase in the unemployment rate. So it on a rounded basis was unchanged, but it was very close to rounding to 4.2%. And that should be pretty clean of these strike and hurricane issues, kind of confirming to us that drop that we saw in the unemployment rate in September is a one-off.
Well, that's what I'm curious about, too. I mean, if you listen to Julie Su, the acting labor secretary, she's sort of taking a look at 3-month rolling averages and other things like that and saying, look, the labor market's still strong. The weakness, though, that we saw in this report, I mean, let's set aside the 12,000 number, which we know is an anomaly. Yeah. But there was a weakness in this report that we saw in previous reports as well. Yeah. And I'm wondering if this is starting to compound to a level where we should start to be worried about the labor market.
Yeah, no, I think we should. We had some pretty big downward revisions to payrolls the last couple months also. Private payroll employment in August now only rose by 37,000 jobs. That's pretty weak. I think we see this weakening labor market dynamic across a number of different data points: low hiring rate, low quit rates, hours worked coming down. This does feel like labor demand that is pretty soft.
And the number that we keep going back to is that unemployment rate, which you pointed out, I mean, on the surface, it looks unchanged, but if you go out 2 decimal points, a different story. Does that portend a more dramatic move in the unemployment rate in the months to come?
Yeah, I think so. Yeah, the unrounded unemployment rate is the new unrounded core inflation, essentially. But yeah, I do think this is kind of confirming that drop in September doesn't necessarily repeat. And when you are in this dynamic of very weak hiring and layoffs that are still low, yes, but when you have such weak hiring, you would be inclined to think people will just stay unemployed for longer, and there's that upward pressure on the unemployment rate still.
So what does this mean for how the Fed proceeds? I mean, we're talking about 25 basis points pretty much baked in for November, but how does this shift the odds for December?
Yeah, 25 basis points next week, but we do think this is a genuine weakening trend in the labor market, and maybe it's that November employment report, of course, that could confirm some of this weakness. I think people are kind of looking through this October data for now, but we'll get that November employment report before the December FOMC meeting. We think the Fed is cutting 50 then.
50?
Really?
Yes.
Well, gets to the idea, though, too, because a lot of people, I mean, I don't know, if you've been watching this program and you watched it last week, you would believe the Fed was done cutting rates. But, I mean, this gets to the seesaw that the Fed is having to deal with, looking at these data points and try to make sense of it here. As we get into next week's meeting, which, of course, is just a couple of days after the election, and then the December meeting, do you think that the argument behind closed doors amongst the Fed members will be more tilted towards a 50 basis point cut? I don't mean what Jay Powell wants, but I mean what the other members are willing to live with. Or do you think there's going to be a lot more talk about a pause, a prolonged pause?
Yeah, I think the discussions at this meeting will probably be pretty neutral. We did maybe have some stronger inflation data with September core inflation this week, stronger at least than July and August had been. But I think most Fed officials will see the increase in the unemployment rate and know that rates are very restrictive and be pretty worried about that increase.
Yeah.
When rates are as restrictive as they are, you want to pretty quickly get back to neutral in a weakening labor market.
Yeah, that might be an well, so it gets to this idea, though. I mean, do you know where neutral is? Because, I mean, Jay Powell's going to ask about, if he knows, he's certainly not telling us, and no one else seems to know. This seems to be the parlor game.
We don't know, but by the highest estimate that Fed officials will place for that long run dot, we're still 100 basis points away from it. So it's easier to go big when you're pretty far away from neutral, at least.
I'm thinking about the market reaction to the jobs report and how bonds initially rallied, and then, of course, they reversed course. So far in 2024, David Rosenberg has said that the non-farm payrolls has been revised down 80% of the time by cumulative 337,000. Why does the bond market still trade off the initial print?
Yeah, no, I mean, we are very sensitive to every single data point at this point. But yeah, those downward revisions have been pretty big. And that's even before factoring in, we did get preliminary estimates of the benchmark revisions a couple months ago. That implies payrolls are overstated by about 70K right now. Yeah, we're just very sensitive to every data point. I think right now, too, we do have the election, of course, on Tuesday, and that's preventing people from really reading too much into the data for now.